put the same $100 into a Roth account versus a traditional account, and by retirement, one of them could be worth thousands of dollars more than the other, and it has nothing to do with which one performs better. Let's break down the actual mechanism because most explanations skip the part that matters. A traditional account works like this. The $100 goes in before taxes touch it. That lowers what you owe the IRS this year. But when you pull that money out in retirement, the government taxes the entire withdrawal as regular income, both what you put in and everything it grew into. A Roth account works the opposite way. The $100 goes in after taxes. You don't get any deduction today. But when you pull that money out in retirement, every dollar comes out completely tax-free, including all the growth on top of it. So here's the actual question. Neither option answers by itself. What tax bracket are you in now, and what tax bracket will you likely be in when you retire? If your tax rate stays exactly the same both times, the math works out identical. $100 in a traditional account and $100 in a Roth account end up worth the exact same amount after taxes. That surprises most people because it feels like Roth should just be better since it's tax-free later. But taxed once at 22% today or taxed once at 22% down the road is still the same haircut, just at a different point in time. The math only tips one way or the other when your tax rate actually changes between now and retirement. If you expect to be in a lower tax bracket in retirement than you are right now, traditional comes out ahead because you take the tax break while your rate is higher. If you expect to be in a higher tax bracket in retirement, Roth comes out ahead because you lock in today's lower rate instead of paying more later. There's a second difference that has nothing to do with tax brackets at all. Traditional accounts force you to start withdrawing money at a certain age, whether you need it or not, because the government wants its tax revenue eventually. Roth accounts have no such requirement during your lifetime. The money can sit there growing for as long as you want. There's also a flexibility difference while you're young. With a Roth, you can pull out the amount you originally contributed at any time, tax and penalty free, since that money was already taxed going in. Try that with a traditional account before 59.5, and you're paying income tax plus a 10% penalty on the way out. So the mechanism comes down to this. Traditional trades a tax break today for a tax bill later. Roth trades no tax break today for tax-free money later. Neither one is universally the better choice. It depends entirely on which side of the tax rate bet you're on. Now you know exactly what's happening under the hood of both accounts.